and they in fact pulled the Nifty up by close to around 50 points out of the 150 points. Reema, the rupee is depreciating. Impact on the IT space, how's it looking?
Well, you know, we do a very simplistic analysis, right? We always say that, oh, the rupee is depreciated and therefore it should be a positive for the IT companies' margins. But you also have to take into account the movement of the other currencies. You know, there is a very big element of cross-currency headwinds. Okay. So let's just take a look at what's happened from the 30th of September, because that's the end of Q2 and, you know, it will mark the quarter that we're currently in Q3. So from those levels, the rupee has depreciated by close to about 3%. But the non-dollar currencies, for instance, the euro, the Australian dollar, the pound, these have also depreciated against the dollar. And they've depreciated anywhere between 2.5% to up to 5%. This is up to, you know, from the September end closing level to the level. And now, roughly about 30 to 40% of an IT company's revenues is non-dollar denominated. Okay, so on this, you are also facing a rupee depreciation, which gives you a cross-currency headwinds, which means straight away on the company's dollar revenue, there could be a hit of close to about 120, 150 basis points. These are very rough approximations that we're making, but this is the cross-currency headwind that you will see on your dollar revenue. So the net impact because of the rupee depreciation plus the cross-currency will only be about 1.5%, 1.7% in terms of the final rupee rate. Yeah. That will be the net impact. Now, roughly, you know, because generally the visa rules have been tightening, companies have reduced their exposure to the number of employees that they send on visa. So now a 1% rupee that's 25 basis points, not 250 basis points. So let's just make that correction. It's about 20 to 25 basis points. So that 1.5% rupee depreciation can only aid your margins by 30 to 40 basis points. So that is a rough analysis that we're trying to get at, that a good part of the benefit on the, you know, company's margins is going to be taken away on account of the cross-currency headwinds. But why have the stocks started moving up? We spoke to a whole host of, people who look at the IT sector. One, they're saying it's the TINA factor at play. There is no other alternative at a time when the domestic economy is crunching. Secondly, the rupee depreciation, while may not be a huge positive, it's definitely a sentiment positive for the IT companies. And thirdly, and the most important one, is that maybe the cyclical headwinds could have bottomed out, and there the biggest cyclical headwind was the BFSI sector. And there, for the US companies, the US banks have reported not better than expected, but better numbers in the quarter gone by. So in fact, the US banks have reported a revenue growth this time versus a contraction that we've seen in the last 5-6 quarters. And going ahead, if the US interest rates go up, it only means that discretionary spending could come back for the US global bank. So the cyclical headwind, which is BFSI, maybe has just probably bottomed out. Also, we've seen a very significant PE erosion. What we're trying to get at is in the last 6 months, from the top, IT companies have seen a correction of close to about 20%. But the EPS has only been corrected by 5 to 6%. So the rest of it is purely on account of a valuation multiple contraction. And now most of the stocks are trading at 3-year, 4-year low. They're trading well below one lower than their standard deviation as well. And there is also feedback that some of the funds who were materially underweight the IT stocks have started cutting down. They're trimming their underweight position. It's not that people have gone overweight. They're not even probably neutral. But some of the ones who are seriously underweight have started trimming it. That said, they're still very cognizant of the big risk, and that is Trump-driven immigration restrictions. But that still has to, play out.
All right, Reema, thanks so much for making sense for